Two founders sell their business for $35 million. One runs out of money, the other doubles their net worth. Same sale price, same investment return, same spending. I know, that sounds impossible. The difference wasn't investment performance, market timing, or spending. It's taxes. And there are proven strategies to avoid them. Investment markets can be unknown, but the main aspects of the tax code are set. I mean, if you don't understand this before the sale, or at least immediately after it, you can quietly drain millions of dollars from your portfolio without ever realizing it. Most founders delay planning until after the deal closes. I've heard it a million times. I just need to get this deal closed and then I can focus on it. That mindset has cost founders that came to me too late millions of dollars on the sale. And then it continues. The portfolio gets built without any tax strategy, and the result is the portfolio becomes a tax-paying perpetual machine. Rebalance your portfolio? Taxed. K1 from a private fund with a big capital gain? Taxed. Earn high income from a private credit fund? Taxed, and at the highest ordinary income tax rate. Big future gain on a holdback or rolled equity? Taxed. You got a pile of money, so none of this feels dangerous in year one. You feel rich. Over 20, 30, or 40 years, this can be fatal to your wealth and lead to a lifestyle you never imagined, pinching pennies when you thought you were wealthy. This is episode 3 in our 3-part series on how to pay less tax and make more money after a business sale. In episode 1, we showed how long-short tax loss harvesting saved a founder client of ours $3 million on a $35 million business sale. In episode 2, we broke down how taxes quietly erode your portfolio and how we reduce that drag so you can compound more money over time. Today, I want to show you how that actually plays out over decades. The results surprise almost everyone. Conventional financial advisors, they don't care about your taxes. They care about their fees. The tax bill, that's your problem. And many will tell you investments don't matter after the sale. That's wrong too. Investments are at the core of how we create value. I'm Nick Bartolo, founder and managing partner of Essential Partners. I started out as a CPA, spent 17 years on Wall Street, helping to manage money for some of the largest institutions in the world. At Essential Partners, our clients have exited over $500 million in business sale transactions over the last 16 months. We exist for one reason: to help business owners with 8- and 9-figure exits maximize after-tax wealth. I'm going to break down a proprietary and proven framework on how to pay less tax so you can make more money after your business sale. If you haven't watched episode 1 and 2, this will still make sense. But if you start there, you'll get the reasoning that much faster. You don't need to agree with me yet, just follow the math. If the math holds, the conclusion becomes unavoidable. I've seen this play out repeatedly with real clients. One comes to us before the deal, and the other comes to us after the deal has already closed. Here's some real examples. We had an $80+ million deal close in Thanksgiving of last year. We also had a $30+ million deal close in mid-December. Those sellers found us too late in the year and after the deal had closed. Contrast that with a $200 million deal that closed in April, where we had been discussing tax planning for over 2 years. The difference? The first 2 deals had limited tax savings on the upfront cash payment. But because we had time later, we eliminated the taxes on the holdback from the $80 million deal in the following year. And on the $30+ million deal, we continue to execute tax mitigation strategies on the rolled equity gain they will receive in a few years. The $200 million deal, we're going to generate approximately $14 million of tax savings in the year of the transaction, and an additional $6 million of tax savings over the subsequent 2 years from the earnout and holdback tax savings. Those are real outcomes. But to isolate the strategies from episode 1 and episode 2, and to keep it clean, we're going to normalize all of the numbers. We're starting with a $35 million business sale, and after the sale, we'll use the same investment returns, same tax rates, and same spending. This video is split into 3 sections. Section 1 is the business sale, strategies to pay less tax versus no tax strategy. Section 2 is the portfolio after the sale, tax efficient investing versus no tax strategy on the portfolio. And section 3 is the long-term outcome, how these strategies diverge over 20 and 40 years. And here's what I want you watching for in section 3. Small differences don't stay small. they compound into absurdly large differences over time. Let's dig into section 1, the business sale. A $35 million business sale is a fantastic result, but there's a problem, an $8.75 million problem. This is the first fork in the road. Most people assume and are given the advice to just pay the tax and move on, but the tax damage starts here. The conventional approach of wealth management is to use off-the-shelf software in order to generate financial forecasts for their clients. At Essential Partners, given our focus on after-tax wealth and after-tax investment returns, we've built our own proprietary model in order to generate the forecast for these scenarios. To give you a behind-the-scenes look, we have spreadsheets on the screen of the actual model and inputs that are generating these scenarios in the examples that we're discussing. Each individual client has a specialized design forecast, ensuring the tax strategy design is appropriate within the context of the essential exit framework. We're going to assume this business sale closes on January 1st. It's an S Corp, so for tax purposes, there's a 20% federal tax rate. We're also going to assume a 5% state tax rate. As you likely know, state taxes can range from 0% in states like Florida, Nevada, and Texas, all the way up to 13.3% in California. And yes, there does seem to be a correlation, unfortunately, between corruption and how high a state tax is. I see you, Minnesota, at nearly 10%, California at 13.3%, and New York well above 10%. Back to the sale. In episode 1, I broke down all of the details of long-short tax loss harvesting, but I want to recap something important here. This strategy is an investment strategy, first and foremost. It invests in U.S. public stocks, and since inception, it's outperformed the broad U.S. indices like the Russell 1000 or Russell 3000. That part matters because this isn't some tax-only construct. It's an investment strategy first, designed to generate returns. But here's where it gets interesting and where most people misunderstand it. The strategy can be custom designed based on the individual circumstances of the client or the market environment. Business owners are used to controlling their net worth. So imagine I go to an owner who just sold their business for $35 million and I say, hey, congratulations on the deal. Now let me just take 70 or 80% of that money and plop it in the US stock market. And if it goes down 20 or 40 or 50%, oh no, don't worry about it. Just sit tight. It always comes back. And look, there is some truth to that, but psychologically and practically, that's a terrible first step for a founder who just had a liquidity event. Most founders don't miss all the headaches in running the business, but they miss control. Bad portfolio design replaces control with anxiety. If this sounds familiar, this part's for you. In the first year or two after a sale, keeping risk and volatility low is often the better approach. Not because markets won't recover, but because founders are recalibrating after a lifetime of control. Here's where long-short tax loss harvesting becomes powerful. The strategy can be designed to take no directional market risk. What does that mean? During the first quarter of 2025, when the US stock market declined over 20%, the market neutral long-short tax loss harvesting portfolios under our advisement had positive performance during that period. And importantly, the tax benefits during that period continued. Losses were still harvested, tax assets were still created. Under the right circumstances, we can also design these portfolios to take partial US stock market exposure, 50%, for instance. So if the stock market is up 20%, we would expect these portfolios to be up 10%, plus the outperformance of the quantitative investment manager. That flexibility is intentional. It allows founders to go from this concentrated business risk, their own business, into a diversified portfolio with their capital without the emotional toll of the market going down 30% and capturing all of that downside. None of this requires perfect market timing. It's about controlling what we can control and designing to the client's circumstances. After that very long tangent, which I do think is important because it shows the flexibility to each client and the market environment, but let's just get back to our example. In this situation, we're investing $10 million in a long-short tax loss harvesting strategy using a portion of the $35 million of proceeds received from the sale. The expected return is 10% for the year, which is solely based on the long-term expected return of the US stock market, assuming no outperformance from the manager. But here's the key. That portfolio is also expected to generate $9.4 million in realized capital losses. Those losses are a direct offset to the $35 million capital gain in the year of the business sale. So now, instead of a $35 million gain, there's a $25.6 million gain. Apply the 25% tax rate, and total taxes drop to $6.4 million, down from $8.75 million. A $2.4 million savings. This is not a shady loophole or gray area. These realized losses are delivered on a 1099 form from Fidelity that also gets reported to the IRS. The money is invested and growing, just like any other investment, such as an index ETF, without getting the tax benefits. You do not lose access to the money, and you have daily transparency by logging into a Fidelity or Schwab account. This is money that never needs to be repaid to the IRS. Think about what $2.4 million actually means. Yes, you could spend it. You could buy a really nice vacation home. You could buy a bunch of family members their own homes. But let's say we invest that $2.4 million and it grows at 9% over 20 years. That's $13.5 million. Over 40 years, it grows to $75 million. I mean, forget the $35 million business sale. This $2.4 million in tax savings can turn into generational wealth. And think about those numbers. But despite that, the conventional wealth management industry, they don't pay attention to taxes. They just want you to sell your business, pay your taxes, give them the money so they can put it in a cookie cutter portfolio and earn a fee off of it. But as the math shows, if you pay attention to tax, that $2.4 million turns into $13.5 million after 20 years and $75 million after 40 years. I know I'm like a broken record, but after-tax wealth is all that really matters. Most of the founders I work with would rather donate that money to their church or charity than let the government just waste it. And even in the short term, let's say we invest that $2.4 million in high yielding income strategies generating 9%, multi-strategy debt. That $2.4 million at 9% turns into an incremental $216,000 that you would have year after year to augment all of your cash flow planning to replace the income from your business. That alone can significantly change your lifestyle planning after a sale. Let's go back to the comparison. So after just this one strategy, the client now is starting with a portfolio of $28.6 million as opposed to the no tax strategy example that's $26.25 million. This is where most business owners think their tax problem is gone. But in reality, the tax sinkholes in their portfolio are just beginning, and the majority of their tax problems will come after the sale. Let's go to section 2, the post-sale tax-efficient portfolio strategy versus no tax strategy. Now we get to the part that almost no one talks about, but where the vast majority of the damage actually happens. Conventional portfolios after a business sale have serious tax problems. And if you've never sold a business before, you're probably not aware of them or the corrosive impact they can have on your portfolio value over time. This is not about saving a little here and a little there. It can be the difference between doubling or tripling your net worth versus running out of money in old age. And we're talking about the same returns, same spending, same markets, and same tax rates. I know that probably sounds dramatic, but stay with me. The math is brutal. The purpose of this section is simple. I want to show you the result of managing a tax-efficient portfolio versus a portfolio with no tax strategy at all. Because after the sale, taxes do not go away. They multiply, and you have fewer tools versus when you were a business owner to offset them. Let's talk about where portfolios start breaking. You sell your business, you used to have cash flow for your business, but now you need cash flow from your portfolio. So your advisor says, I have some great income strategies for you. They pay 9%. You think, wow, that's great. But in some states, that 9% can be taxed over 50%. So instead of 9%, you now have an after-tax return of 4 to 5%, a stark difference. Half of your income is gone before it even hits your bank account. And no one feels this immediately. And that's why it's so dangerous. Remember, high income does not equal high after-tax income. Now let's keep going. Your investments appreciate, but you want to rebalance that portfolio. The problem is there's a lot of capital gains that are generated when you go to rebalance that portfolio. This triggers another tax problem. You sell appreciated assets, trigger capital gains, taxed portfolio sinkhole. Then there are private funds. A tax form K1 shows up with big capital gains, even though you didn't sell. Taxed. Then maybe you invested in a private fund that has a large gain, but is now being liquidated. Another capital gain. Taxed. This is what I mean when I say that your portfolio has become a perpetual tax-producing machine. Not because anyone's doing anything wrong, but because portfolios typically aren't designed with taxes in mind. In episode 2, I walked through what I call our three-legged stool. The three legs of the stool are long-short tax loss harvesting, tax-aware hedge fund 1, and tax-aware hedge fund 2. Back to my creative names. Each leg has a job. The long-short tax loss harvesting strategy is the engine. It eliminates capital gains taxes from rebalancing the portfolio, private fund K1s, selling appreciated assets, and any other capital gain that's likely to occur in your life. Then we pair it with the other two legs of the stool, and something powerful happens. We're still generating investment returns from all three legs of the stool, but now we have greater diversification, and we're reducing ordinary income taxes on either your portfolio or other aspects of your life. This is the part that most other advisors do not understand, but it's core to our essential exit tax framework. Other advisors manage assets, but we manage after-tax outcomes. And this is not about being aggressive. It's about being intentional. Let's bring it back to the $35 million business sale, and let's make it real. Because we don't design cookie-cutter portfolios. We design portfolios for each client's individual circumstances and life. So in this example, the founder is 50 years old, in great shape, so they're likely to live to 90 years old or beyond. And this matters. Most rules of thumbs you hear in retirement assume a 25 or 30-year retirement period. That does not apply here. This is potentially a 40-plus year runway. And if you've heard of the 4% rule, here's the warning label. With a 40-year retirement, the 4% rule can fail. So you've been warned. Now let's get into specifics. This founder wants to spend just over $1 million per year. To keep it clean and to use the 4% rule, let's assume $1.05 million, which is exactly 4% of the no tax strategy portfolio of $26.25 million. That's our baseline. Now let's compare it to the tax efficient path. Because of the tax savings on the sale, that $2.4 million we saved using long-short tax loss harvesting, this portfolio value is $28.6 million. So same spending, but the withdrawal rate goes down to 3.67% from 4% in the no tax strategy example. That difference matters more than people realize. We also assume spending grows at 3% to keep the model straightforward and in touch with reality. In practice, we typically model spending increases up to 80 years old, at which point travel and other discretionary spending typically declines for older clients. But for this example, we're just going to grow 3% forever in order to be conservative. And from here, the math takes over. This is the moment that founders usually pause, because they realize something uncomfortable. You can sell your business for what feels like an enormous number, but you can make irreversible mistakes in your tax strategy that can lead to ruin. Not because you spent too much and not because markets failed, but because taxes interrupted your compounding, destroying wealth year after year. And that's what we're about to visualize in the charts. Now let's move on to section 3, which is the long-term outcome. Before we look at the charts, I want to make it very clear and look at the rules of the comparison, because this is where people think there's some trick. From this point forward, the rules do not change. We're talking about the same spending, the same tax code, and the same investment returns. No hero assumptions, no market timing, no excessive risk taking. The only difference is if taxes are managed intentionally or ignored. This is not a moonshot portfolio. It's a portfolio designed for business owners who have sold their business. The goal is to generate high single-digit returns with less volatility than the overall stock market, and do so while being conscious of economic environments and market cycles to reduce overall volatility. Because excessive volatility leads to unforced errors in decision-making. Here's how it's built for this scenario. 35% of the portfolio is in income-producing assets. This can be multi-strategy debt, it can be investment-grade debt, treasury bills, et cetera. But the goal is to generate income to replace the cash flow of the business with low volatility. The other 65% of the portfolio are in appreciating assets. And this is where the growth of the portfolio comes in. It can be public equities executed through the tax loss harvesting strategy. It can be in real assets like gold and commodities. It can be private investments. It can be private equity. It can be tax-aware hedge funds. But the goal is to have long-term appreciation. The blended return that I'm using for this example after all fees is 7%. That's important because nothing in this portfolio is assuming heroic returns, crazy risk, or unrealistic performance. In fact, I think our returns are likely to be closer to 8 to 10%. We manage money for the portfolio to be resilient in all types of economic environments. Sometimes that might seem unconventional to business owners, and that's exactly why it works. Now, here's the part where the two paths diverge. In the tax-efficient portfolio, 35% of the investments are allocated to US stocks, but executed in the long-short tax loss harvesting strategy. That's what it is in this example, but for others, it could be 10% or 20%. Again, depending on the initial gain and the client's specific situation. We expect this strategy to continue to outperform the US stock market and generate these valuable tax assets. Even performing in line with the US stock market, we expect 10% returns, which has been the case over the past 100 years. Consistent with the performance of the US stock market over the past 100 years, we're expecting this strategy to generate 10% plus returns, while at the same time generating realized losses that can help offset capital gains associated with rebalancing a portfolio, Form K-1 capital gains delivered from private investments, or any future liquidity events that are likely to generate capital gains. And then, when it's paired with tax-aware hedge funds, the portfolio can reduce the ordinary income taxes on that 35% of the portfolio that's in income-producing assets that are typically taxed at the highest tax rate. Now you have this tax minimization engine that's continuing to reduce the taxes on ordinary income into the future. The conventional portfolio, it doesn't have any of these strategies. And that omission is what causes the slow bleed. Now let's dig into the model. As you see here on the screen, this is the actual proprietary model that we use in order to develop and monitor tax-efficient portfolios. In the top left-hand corner here, you see the actual calculations of the initial tax savings on the capital gain. So 10 million invested in the long-short tax loss harvesting portfolio results in 9.4 million of realized gains in that year, in addition to the 10% return, growing that 10 million to 11 million. So on this $35 million business sale, you have a reduction of 9.4 million of the gain, resulting in a gain of 25.58 million. Applying our normalized 25% tax rate results in 6.395 million of taxes, which is a 2.355 million of savings versus the 8.75 million in the core scenario. You see, if we expand this, we have the no strategy scenario and the resulting 8.75 million of taxes, which, over 40 years at a 9% return, just that tax difference alone will lead to generational wealth of $74 million. Now let's move on to the after-tax portfolio, contrasting the tax-efficient portfolio and the strategy with no tax strategy. So in order to do that, the first thing I want to do is I want to normalize these two scenarios to start with the same number. So we take that 2.4 million out because we already know that's going to lead to a strong advantage over time for the tax efficient portfolio. So let's start at a baseline of the no tax strategy. So we're going to normalize these portfolios and just start with the same value of 26.25 million. That way we see only the impact of the portfolio strategy after the sale, as opposed to also seeing the impact of the 2.4 million in upfront tax savings, but we'll show that comparison later. So the withdrawal rate on both portfolios is 4%. Again, that spending amount grows with inflation of around 3% in this scenario, and we're just going to keep that consistent throughout the 40-year period. Now let's dig into the actual model. The initial value of 26.25 million is here. As we mentioned, we're going to assume that income-oriented investments are 35% of the portfolio, or 9.2 million overall here. The return that we're assuming is fairly conservative at 5.3%, assuming a portion is invested in investment grade or US government bonds, and the remaining portion is invested in a multi-strategy debt portfolio designed by our investment team. So the results of that is 482,000 of pre-tax income from income-oriented investments. And these income-oriented investments, they carry the highest tax rate. And so if we go to the no strategy scenario, you can see that they're taxed in our 5% state tax scenario at a combined rate of 27%. The marginal tax rate, or the incremental tax rate, is far higher, but the average tax rate on that entire 482,000 here is 27%. And that results in total taxes of 107,000 at the federal level and an additional 24,000 at the state level. So substantial, over $130,000 tax burden. When we compare that to the Essential Partners tax efficient portfolio, you can see we have this column here. It's called income reduction. So because of the three-legged stool, which is the combination of long-short tax loss harvesting and two tax-aware hedge funds, we're able to actually reduce the ordinary income tax burden because for tax purposes, we're generating ordinary losses while still making money on the investments. So instead of paying over $130,000 in taxes, this tax-efficient portfolio pays just over $16,000 in taxes. Actually, not quite $16,000 in taxes. So you can see on an after-tax basis, you now have $466,000 just from the income producing portion of the portfolio, whereas in the no tax strategy scenario, you only have $350,000. So what happens next? We've laid out that this person wants to spend 1.05 million every year. So we need to generate cash flow, not just from the income portion of the portfolio, but from the appreciating portion of the portfolio. So what does that look like in the no tax strategy scenario? Well, let's continue on in this model. Here's the 1.05 million of spending that this client is planning on doing, growing at 3% over time. So after paying taxes on the income portion of the portfolio, they need another $700,000 of cash flow in order to meet their spending needs. So they're going to have to take that from the appreciating portion of the portfolio. If that portfolio is generating nearly 8% of investment performance, which I think is conservative over the long term based on our strategies, that's an additional $1.35 million of essentially income from the portfolio. That's $1.35 million of appreciation of the portfolio that can be sold and then used to fund this lifestyle need. However, there are taxes associated with selling appreciated assets. Clearly, you could sell some portion of the portfolio that hasn't appreciated yet, but more likely than not, over time, you're going to have to sell appreciated assets and pay the capital gains tax. So for the simplicity of this example, there's $700,000 of capital gains that will need to be realized on taxes in order to meet these spending needs. Applying our 25% capital gains tax rate, that results in an additional $175,000 of taxes right here. So now this overall portfolio has paid $341,000 in taxes, and the pre-tax return of 7% after all fees is now down to 5.7% on an after-tax basis. This model assumes that all of the spending that needs to come from capital gains does so from actually taxable gains. In reality, you also have a portion of the portfolio where you're just distributing capital that you've already paid tax on. This model also assumes that none of the rebalancing that needs to take place in order to maintain this 35% in income producing assets versus 65% in appreciating assets has no tax friction associated with that rebalancing. That's a favorable assumption for this no tax strategy scenario, but it's offset quantitatively by the assumption that all spending that's coming from the appreciating portfolio gets taxed as capital gains. So you see the result on an after-tax basis, and also after spending the 1.05 million, the portfolio grows by 440,000. Now let's move to the Essential Partners tax efficient portfolio. You see, same assumptions, 26.25 million with 35% in income producing assets. That income producing assets is about 9.2 million, generating again 482,000. But because of that income reduction, we're only paying slightly less than 16,000 as I laid out previously. So in order to meet the 1.05 million spending objective, we have more money because we didn't have the high tax burden as the no tax strategy scenario. So now we only need $583,000 of spending. However, we have this tax engine here, the long short tax loss harvesting strategy, $10 million. They not only saved us 2.4 million on the initial sale, but is going to continue to produce tax assets in the form of realized capital losses while still growing that portfolio. So you see here, this 10 million is producing an incremental 4.5 million of realized losses. So if we need to spend another 583,000, and that's going to be a taxable capital gain, because we have these losses, that now becomes tax-free. And the result of that is that there's no incremental taxes on taking money from the appreciating portion of the portfolio. So you see here, the total tax in this scenario is $16,000 because all of those capital gains become tax-free due to the long short tax loss harvesting strategy. So compare that $16,000 of total tax to $342,000 of total tax. There's a lot of critiques in the wealth management industry about fees. And I actually think a lot of them are well-founded. And that's because you're typically in a cookie cutter portfolio that you could build on your own with no tax planning. So let's talk about fees in the context of tax planning. And most people, they don't want to talk about fees. They want to talk about these little percentages and they don't want to talk about the big numbers. But let's just address it directly. So in the Essential Partners tax efficient portfolio, you're paying about $16,000 estimated in taxes. In the no tax strategy scenario, you're paying $342,000 in taxes. So let's get the 12C out and run a little simple math here. So 342 minus 16, that's $326,000 of value just from tax. That's no estate planning, that's no investments, that's just from tax planning, okay? And it doesn't include the 2.4 million that is saved up front on the actual business sale. But let's leave that to the side because that alone could cover fees for a lifetime. So on a $26.25 million portfolio, let's assume a 70 basis point fee or 0.7%. That's $184,000. So $184,000 minus $326,000 is still $143,000 of incremental value to the client, well above fees, just from tax planning alone in a single year. And that amount of savings compounds through investments year after year after year, and that tax savings persists. So I get it. $184,000 is a lot of money to pay a wealth manager, but there's clear deliverable value both on the sale and later due to tax planning while getting the investments essentially for free. One of my favorite Steve Jobs quotes is all business is adding value to someone else's life, whether that's a nice product like an iPhone, a service, or tax savings. So if we can add that kind of value to someone else's life just from tax planning alone, and then the additional value that comes through in investments, trust and estate planning, financial forecasting, etc., we feel very comfortable with that scenario. And keep in mind, this is a proprietary model. We've tried all types of the financial forecasting and investment models that are off the shelf for conventional wealth management firms, but nothing could satisfy the tax demands and the tax planning and tax strategy that we do. So we built our own. And this is one core piece of how we think about tax strategy and optimizing it given each client's situation. So what actually kills portfolios? Most business owners, they think portfolios get killed by bad investments, market crashes, spending too much, retiring or selling at the wrong time. But what they miss is friction, small, repetitive friction year after year. Taxes are friction. They don't show up as a headline. They don't feel painful in year one, and they don't trigger a panic. They just quietly interrupt your compounding every single year. Less money compounding, less money to spend, less money to grow. Let's go to the charts. Let's assume that we're starting with the no tax strategy portfolio value of 26.25 million. So you can see the demonstrated impact of just the after-tax portfolio strategies versus no tax strategy. After 10 years, the difference looks manageable, I guess, a $4 million difference. After 20 years, the difference is undeniable, $15 million more in the tax-efficient portfolio. And this is where things get concerning. At 30 years, the paths are clearly divergent with a $37 million difference. The tax-efficient portfolio is still continuing to work and grow wealth, despite spending continuing to increase at 3%. The no strategy portfolio is fighting the gravity of taxes. At 40 years, it's just flat out uncomfortable. The tax-efficient portfolio is still compounding, and the conventional portfolio is out of money at year 38. Not in a crash, not in a crisis. Slowly bleeding out. This is how wealth disappears without anyone noticing. Most advisors are trained to optimize portfolios, not outcomes. Taxes live outside their model, so they pretend they don't matter. Here's the part most spreadsheets don't capture. When portfolios start shrinking, most founders don't say, I guess my tax drag caught up with me. They more likely say, markets aren't what they used to be. Maybe I should take more risk. I just must have sold my business too early. Maybe I need more yield. So they reach. And then when you reach and you take more risk, now you have a tax problem and an investment problem. Taxes don't just reduce wealth, they change behavior. And then you have an investment problem. Now let's compare the real situation, which makes the comparison look flat out wrong. But when in fact, having a tax efficient portfolio is just unfair. Remember the $2.4 million that we saved on the initial business sale? Instead of spending it, instead of donating it, or instead of handing it over to the government, we invested it. So now the starting point changes. In the tax strategy example, we're starting with $28.6 million. And in the no tax strategy example, we're starting with $26.25 million. Same spending, same 7% investment return, same tax code. This is still the same situation, but just using the proven tax strategies discussed in episode 1 and episode 2. The $2.4 million in additional tax savings up front does two things simultaneously. It lowers the initial withdrawal rate and it compounds over a long period of time. The combination of these two factors is lethal, and I mean that in a good way. Now let's look at the graph. The tax-efficient portfolio after 20 years has over $53 million, and the no strategy portfolio, a little less than $30 million. So if we zoom out further into the future after 40 years, the tax-efficient portfolio has nearly $100 million. And again, we haven't changed the returns, we haven't changed any of the assumptions. Whereas the no tax strategy portfolio, again, runs out of money after 38 years. So let this sink in. That initial $2.4 million of tax savings after 40 years at a 7% return has now grown to $36 million of this $100 million difference between the two portfolios. And this $100 million difference, it's not investment brilliance. It's having a clue about investment tax strategies and focusing on business owners who are having an exit at some point in the future. And we've had over 500 million in business exits just over the past 16 months. So this is the shift that business owners have to make. Before the sale, concentration is the way to get rich. Execution speed matters, and aggressive offense can lead to rapid business growth. But after the sale, friction can kill portfolios. Mistakes compound. And sometimes the best defense is the strongest offense. And defense creates freedom. This is why I say, get rich with concentration, stay rich with diversification, and smart tax strategy. And I'm not talking about the type of diversification that looks good on a pie chart. I'm talking about true diversification that survives over decades. And all of this is why I don't care about your pre-tax returns or your neighbors. And it's also why I think it's just lazy advice to take somebody's life work on their business sale and go dump 70 to 80% of that life's work into the US stock market. This is why most wealth managers don't understand business owner exits at all. They manage assets, not outcomes, and definitely not on an after-tax basis. By managing money on an after-tax basis, you're creating lifestyle durability, optionality, freedom, and whether the wealth you built actually lasts. There are 3 conclusions I want you to take away from this. First, tax strategy on the business sale matters. Second, tax strategy on your portfolio after the sale matters even more. 2 smart founders can do everything conventionally right, but their financial realities can diverge substantially just because of tax strategy. Third, you don't need higher returns, you need less tax leakage. If you're approaching a sale or you've already closed, this isn't about optimization. It's about survival and the lifestyle that you've earned. If this changes how you think about your exit, that's the point. You don't need to act today. You just need to stop letting taxes make decisions for you.